When the stock market's up, I think we all feel really good. But when it's down, for some, that can feel pretty scary. Do your investments match a strategy, or do they match your emotions? And in today's episode, we're going to discuss how you can tell how much investment risk that you're taking and what that means for your retirement savings. We're going to talk about strategies to help reduce risk without reducing opportunity, and then determining how much investment risk is appropriate for you.
Welcome to the Your Life, Your Money podcast with Scott Searins, teaching you how to thrive in life, wealth, and retirement.
Welcome into Your Life, Your Money, the podcast helping you thrive in life, wealth, and retirement. I'm Ben George. He is Scott Searins over at Searins Financial Group in the Chicagoland area. Scott, welcome in today. What's going on?
Hey, Ben. Thanks. I appreciate it. You know, Ben, I had a question for you. Are you a casino type person? Do you go to the casino ever? You stay away from them?
I am a gambler. Although I will say I did go on a golf trip. I think we talked about it this summer to Turning Stone in Syracuse, which is a resort and casino. And I'd found myself not gambling as much. Maybe it's because of this podcast and I'm learning a little more responsibility with my money. But I do enjoy, though, taking that risk from time to time.
Hey, I'm with you, and I thought it would kind of tie into what we were talking about beforehand to talk about on today's show. And for me, I do enjoy playing blackjack, going to the casino, playing blackjack. I'm with you. Don't like to take a whole lot of risk, but I enjoy sitting there, not only just playing for myself, but like watching others. I don't know if you do that as well when you're there, but I just kind of like watch others, their betting strategies. Sometimes I'm like, what the heck are they thinking? But I think what's always interesting is what people are doing when they're winning and what people are doing when they're losing, right? And I watch is sometimes people, as they're winning, it's like that mentality of greed kicks in, and then they just start putting more out there and putting more out there and putting more out there until they've almost got everything out there. When then they lose, and it's just like, okay, now they're back to their starting spot. And then on the same side, if somebody's just not having the right day at the table, then they're just just kind of keeping it to themselves, I guess. To me, it's really interesting, as we're all so unique, and you and I can both say we're not risk takers and probably sit down at the same table and have totally different betting habits.
Yeah. It is fun. I do like it, but I've kind of peeled back just because I haven't had any luck. I don't have a lot of luck at the tables a lot of times, and I feel like a lot of the games have gotten tighter through the years. Maybe it's an inflation thing. I don't know. Maybe that's their version of inflation. Who knows? But I definitely
the buildings always look beautiful for a reason, right?
They do. All right. So yes, we're talking about risk today, and whether or not you can determine whether or not your risk and your tolerance for risk matches what your financial plan is. And again, what should you do if it is out of whack? I know that, if you are a natural risk taker, like those that like to sit down at the casino table and play some cards or shake some dice. But should you do that when it comes to your finances and when you're thinking long term? So we're going to explore these angles and break it down, this role that risk has in your financial and retirement plan. Again, you can find us online at lifemoneyshow.com. Type in lifemoneyshow.com/taxes too. It takes you right to the tax download. I want to go ahead and push that your way today. It's such a great resource and tool, Scott, that you offer people. That's very simple to use, and it's a free complimentary download just for listening.
Yeah, none of us are a big fan of taxes. I dislike them just as much as everyone listening, and so we've put out some strategies to help people, again, keep their hard-earned money with them versus turning them over to the government and taxes. So I hope they'll find it helpful, but there's a great download there at lifemoneyshow.com/taxes.
All right, so let's start off with risk, Scott. When you sit down with someone and you meeting with them for the first time, let's say, how often do you see their portfolio actually match what they're telling you they feel about risk?
Well, I'm going to kind of turn this into two parts. One is, let's just say it's someone that I've, never met with before. I'm going to say a lot of times they're typically at more risk than they would have guessed or they would have known about. A lot of times, though, they've just been in their working years putting money into their 401k. Maybe they've just picked a target date fund, or maybe they just went in there and they picked the funds with the that showed the highest average returns, but didn't realize the risk that was associated with those funds. So a lot of times, those folks, they don't match up. Like it doesn't match with what they're coming in and saying, well, we're conservative or we're moderate, which all those words are pretty general too. And then I would say someone that maybe has a plan in place, whether or not that plan, or I'll say whether or not their portfolio matches their feelings about risk, is really all dependent on the market. And kind of, back to when we were talking about playing cards earlier, someone who's winning and feeling really, really good, well, they're, feel like they can take on more risk. And I see the same in the market. When we've been going through when we went through the bull market for 10 years, people, right, were just feeling good. And they'd be like, hey, maybe we should put some more money in the market because it's really, really good. And it's that emotional roller coaster, because then as soon as the card table flips and the dealer's winning, just like we're seeing today, then, I find that people's emotions tend to flip as well, where their emotions are, wait a second, I don't know how much risk I want to take on. And, we'll get into this a little bit later, but that's why I like to try to take the emotional part out of it, meaning that emotional roller coaster of when the market's doing good, we feel good. When the market's doing bad, or nobody likes to see their accounts go down. Take that out of it and put strategy into it. But yeah, it depends. And I think, some folks just, they understand, they believe in the market like I do. They believe in that long-term picture. And because of that belief, economic downturns like we're currently seeing doesn't bother them as much. So, just like the betting habits at the gambling table are different, each person kind of has their unique feelings as they're going through market ups and downs.
Well, if somebody's listening to that and going, okay, well, I don't know exactly how much risk I have. I know how I feel about it, and maybe I don't have the right amount of risk in my portfolio. How can someone actually tell and look and assess how much risk they're actually taking on?
So one way to take a look at it is just your asset allocation in your overall portfolio, and how much of your funds and your money do you have sitting on the equity or the stock side. And when you look at that, you have to think about historical market conditions. So like in 01, 02, when we had a big market crash, I think that was, fluctuating to the downside of around, maybe it was 30% or more. 2008, where we saw, around 40% crash in the 2008 time frame. So when you look at that equity portion, or how much of your money that you've got in stocks, knowing that on the downsides, you could potentially see downsides of 10, 20, 30, 40% or more, just based on, some history there. Now, of course, the market has shown us that the upsides in that portion have outperformed the downsides. But I think that's, one quick way to look at it and go, okay, how much do I have at risk? And then how much that I have on the equity side, just knowing based on our conversation here, how much it could potentially fluctuate over time.
Well, when you think about these unnecessary risks that people take, and I think about sitting at the table and, knowing, hey, I probably shouldn't be betting on this game of cards and shouldn't be sitting here for an hour or two, whatever my last round was. Why do you think people take unnecessary risk? Is it just because it's just natural for them? It's just in their nature to gamble a little bit, or is there a deeper reason behind it?
I think for some people, they're natural risk takers, but I think for others, it's that emotion called greed. And I know that we'd all look at ourselves and go, whoa, 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 I'm not a greedy person. But over the last 10 years, as we've, gone through the bull market, if you ever caught yourself at any point in time going, hey, maybe we should put some more money into the market, or maybe we should switch over to a growth side because I hear the market's doing really, really well. Well, that's just our natural emotions pushing us to, put more money into something that's doing good. But we have to remember that that portion can also go down. But, I think it's purely emotions. And that's why I always say is, yes, there's an emotional part to this, but we want to separate logic versus emotion and take more of that logical approach to the risk that we should have in our investment portfolio, and make sure it's a strategy that aligns with our future needs and our income plan.
Well, I know the one of the reasons why people take the risk is they want the growth, right? They want to chase those returns, especially in the era that we are now with high inflation, where you maybe need to make up a little bit of that money that you're losing just on day-to-day expenses. So the question, I guess, is can you still get that growth even if you're reducing risk? I know you won't get as much, but if you do go more conservative, do you have to eliminate all opportunities for growth?
And I think this is where I want to now tie it to the strategy, right? And kind of break this down of, hey, how do we get, like you said, reduce portfolio risk without significantly reducing opportunities for growth? It's just having the proper asset allocation, having a strategy that, matches your overall plan. So do you have your cash set aside, right? Because all of this, the market ups, what causes us to have that emotion of greed. The market downs is what causes us to have that emotion of fear. And so do you have a strategy in place that then you can try to potentially ignore those emotions? So do you have your cash built up? Do you have a year's worth of cash, or 6 months or 3 months? But do you have enough cash built up for your situation? And that way, when we're in a down economic turn like we're seeing today, well, can you just turn to your cash and make withdrawals from your cash? That's one part, right? Having that built up. The next part is your war chest, that next bucket, that pool of funds not subject to the same volatility as the growth bucket. The growth bucket, we talked about that earlier. While we know that we can have some really good growth over a long period of time, we can also see some fluctuations, and those fluctuations could be down 10%, down 20%, down 30%, down 40%. So when the growth bucket, which has historically shown us, and again, past performance doesn't mean future results, but we've historically seen that that's been a really good growth tool, our equities, our stocks. When that fluctuates, do you have a spot to go to when that is fluctuating? Having that spot to go to take your income and supplement your income needs. And that's what I like to nickname as the war chest, but you can look at that as also bond funds. Some people utilize annuities in there. We were talking about I bonds in our last podcast together, right? But a pool of funds not subject to the same volatility as that growth bucket. And to me, it's having this strategy in place that allows you then to not let short-term perspective ruin those potential long-term results. Because I think that's what really hurts people's returns, is when the market's doing good, they're piling in, and then the market turns, fear kicks in, they go and sell, and now they've potentially locked in their losses because then they have to make this other decision of when do they get back in, and that's where overall returns are usually hurt. So first off, getting all the right buckets in place. Second, diversification. So in your buckets, are you diversified? In your bond funds, do you have short term? Do you have, intermediate term? Do you have long term? Do you have corporate bonds? There's so many different bond funds to have to make sure you're diversified in that bucket. In your growth bucket, do you have U.S. equity? Do you have international? Do you have large cap? Do you have mid cap? Do you have small cap? Do you have growth? Do you have value? All of this diversification is what helps us reduce risk as well in our overall portfolios. And then I've talked about it before too. I prefer ETFs or funds over individual stocks. I think having a pool of hundreds of funds will help us reduce our risk versus being in one stock that could do really, really good, but also could do really poorly.
All right, let's finish off this risk conversation by helping people know how they figure out the risk in their portfolio. How do you help somebody understand just how much is appropriate?
And I think that goes back, Ben, to, as we just talked about, the strategy there. So if they can look at their portfolio and go, yeah, I've carved off my cash needs, I've carved off my war chest that aligns with my income plan, and I've got my growth section, and in my war chest I've got 3 years or 5 years or whatever makes somebody feel comfortable, and that's all tied to how much they're going to need for future income. I think they can look at their plan and go, hey, I've got a good strategy in place that aligns with a risk tolerance, aligns with risk that they should be taking for their future. But if it doesn't align, then that's where, they might be a little out of whack. They could potentially be taking on more risk than what's necessary to help them make their money last.
All right, great conversation on risk. I know it's something that everybody's assessing right now and curious about where they are, or maybe where they've been taking too much risk. Now that the market's gone down and they see what those losses could look like on paper, starting to become more of a reality. It makes you really kind of rethink things. So again, lifemoneyshow.com is the website to check out if you want to get in touch with Scott and talk more about your risk. I got a couple of questions to get to again. If you have some for us, send them in through the website. We'll try to feature a couple on the show. Most shows we'll try to get them on here and get Scott's feedback and insight. We got one from Fred. He says, I feel we're at the bottom of the market and we'll finish way up for the year. I'm thinking it would be a good time to load up on stocks. Do you agree?
Boy, great timing on Fred's question, huh?
Not worried about risk, I guess.
Yeah, I can imagine what Fred does on the gambling table.
Yeah.
All right, so I'm going to tell Fred to kind of hit rewind on the podcast and go to where we were talking about the different buckets. And does your portfolio, does your asset allocation align with your overall strategy, the strategy of what you need for income in your future? And if it does, great, then you'll know exactly where to put this money. If it doesn't, then you could be putting the money in stocks, and if the market goes up, that's great, but if the market, continues to go down, you're putting money that you might need for next year's income into something that could, drop another 20% or more or less. And so I'm going to really turn Fred back to having a proper strategy versus just taking on excess risk.
All right, good question, Fred. Thanks for that one. All right, Johnny's next. He says, I have a weird situation. I've been very aggressive about funding my IRAs and 401ks over the years, so I have close to $2 million in those accounts. But I'm only 54 and suddenly find myself needing cash for a major home repair that I didn't expect. I feel poor because I have less than $5,000 in the bank because all my money is tied up in retirement accounts. Should I just take the money out of the IRA and eat the penalty that I have to pay for it for taking it out early?
So the reason Johnny is bringing this up, and this is one thing that we really, really push with our clients, and I'm going to, push folks again to really, I think it'll be helpful for you. Go to lifemoneyshow.com/taxes. Again, it's lifemoneyshow.com/taxes. But one thing Johnny's unfortunately kind of failed to do here is tax diversify himself. And the trouble becomes exactly what he was talking about. He's before age 59 and a half, and all of his money, he said, is sitting in IRAs and 401ks, which if he were to take it out before age 59 and a half, he's going to pay that penalty, that 10% penalty, they call it, for an early withdrawal. After 59 and a half, Johnny doesn't have any issues here. He can take money out to pay for this repair. But prior to that, unfortunately, he's looking at that pre-withdrawal 10%, early withdrawal 10% penalty. So a few other thoughts for Johnny here. One is, I know he called it a major home repair. He didn't necessarily say that it was an emergency home repair. So is it something that can wait? He didn't tell us how much it costs. So is it something that maybe he could reduce his contributions to his IRAs, 401ks just temporarily and save up for the home repair? So I'll say step one, could he save for it? Number two, he mentioned IRAs. No, he didn't say if they're regular or Roth. traditional or Roth IRAs. If he does have a Roth IRA, one caveat in the Roth IRAs is that you can take out your base. Meaning if you've put $100,000 into your Roth IRA and it's grown to $300,000, that initial $100,000, your base, not the growth, but the base, you're able to withdraw from. And then a few other things Johnny could look at is, maybe a home equity loan, just going to the bank to get a loan and then using his income and his cash flow to pay those loans off as soon as possible. I'm a big fan of people being debt free. And so hopefully those are just kind of a few ideas to help him through his process here. But the number one thing that I hope a lot of people catch from this is not being tax diversified. And Johnny here, he's got $2 million in his IRAs and 401ks. That is awesome. Great job saving. But what he's also done is he's deferred all of the taxes on that money until later in his life. And a lot of people think, oh, well, later in my life, my taxes will be lower. Not necessarily, because at age 72, Johnny's going to have to start taking required distributions from these accounts, and his taxable income could potentially be higher in his future than what it is today because he's saved $2 million. And I've worked with a lot of people that have saved $1 million, $2 million, even more. And we're now having to go and work on tax reduction strategies because they're seeing, for some of them, that the tax projections show that their taxable income might be higher in the future than when they were actually working. So they're actually costing themselves more in taxes. So Ben, I'll say it one more time, but I really hope people go and download the tax guide. A lot of great strategies there to stay out of the situation that Johnny is in here, not only tax diversification, but also reducing our long-term tax burden, and talks about a lot of different ways, again, just to help keep more of your hard-earned money with you and in your pocket.
Again, just visit lifemoneyshow.com/taxes. It'll take you right there, and you'll get that guide to unlock the hidden tax savings opportunities. Very easy to follow. Just name, phone number. It's optional, email, and then you can read it right there. It's very simple to do, and great tool as you think about tax planning. All right, we'll close out this episode on that note, Scott. A great conversation on risk. I know it's something that we all need to be paying close attention to always, but I know we are even more now with the market in flux as it is. But hopefully today's episode will help people and at least get them thinking in the right direction and paying more attention to how they are investing.
Hey, I hope, and I'm just going to leave everybody with this. Remember, emotion versus logic. I'll say it one more time. Emotion versus logic. Focus on your strategy and the logical part of your plan, and it'll help you towards that long-term portfolio and investment success.
Outstanding. Thank you, Scott, and thank you for listening to Your Life, Your Money. We'll be back with another episode next week. Please hit subscribe, and we'll talk to you then.
Sierens Financial Group is an independent financial services firm that utilizes a variety of investment and insurance products. Investment advisory services offered only by duly registered individuals through AE Wealth Management, LLC. AE Wealth Management and Sierens Financial Group, Inc. are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Sierens Financial Group, Inc. is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Sierens Financial Group, Inc.